Minutes from the last Fed meeting will soon be released this afternoon. Joining us now, Roger Ferguson, former Fed vice chairman, past president and CEO of TIAA, and CNBC contributor. Roger, great to have you with us.
Great. Nice to be here. How are you today?
Great with this.
He wishes he was here. You should be on set, Roger. You could
have your own chocolate-covered strawberry, too. But on
part of
business.
The edible arrangement. Yeah,
exactly. On to business, Roger. What are we expecting for the Fed minutes, and how have things changed? I feel like things, at least from the investor standpoint, have changed in terms of psyche, in terms of seeing what's going on in the bond market, in terms of seeing inflation roll over since the actual meeting. What are we going to learn from these minutes?
So I think a couple of things. One is I think they're definitely going to reinforce the notion of, a couple of 75 basis point moves. I don't think there's any upside to them in changing that. But I think you put your finger on the question mark, which is what do they have to say about the economy? And in fact, how are they weighing the risk of a slowdown versus inflation? And that's, as you observe, sort of a changing dynamic. Now, be mindful, those minutes are from the last meeting. I haven't heard anything being said in speeches that suggests that they're taking their eye off of the inflation target. But so we'll just have to watch and see. But I think that's really the balance question right now.
What's your assessment, Roger? I mean, we've seen commodity prices roll over firmly. We've seen the dollar really strengthen, which helps the Fed's goal of price stability. We've seen yield curve inversion now. How do you sort of put these things together?
Look, I put these things together and recognize that indeed, the Fed's actions and their words are having the desired effect. They're absolutely telling markets that they are going to raise rates enough to see inflation come under control. There's a fear, I think, that, shown in the inverted yield curve, that in fact they'll raise and then things may slow down a little more quickly than they like. Everyone is hearing the R word, the recession word, being bandied about here. And so I think what markets are focused on is just that teeter-totter, that balance of will they get inflation under control? Yes, we think they will. On the other hand, there's always a risk that they'll go a little too far and slow the economy more than maybe people would like. And I think the markets are clearly pricing in that possibility as well. So this always happens during a cycle of this type. The market tries to figure out, all right, are they going to go too far? Are they going to have to cut relatively quickly, maybe towards the end of 2023? And that, I think, is what's going on in the market right now.
Roger, for a while now, we've been struggling with trying to describe the nature of this latest bout of inflation. And I think the Fed has struggled with it as well. Initially, I think there was reason to believe it was transitory, and that was a decent word to use at that time. But that, we're not even allowed to say the T word anymore because it turned out to be much stickier than we thought. But I still think we're not describing it effectively. It seems a little bit different than past cycles. And now we're seeing what I'm getting to is that commodity prices are rolling over. But I wonder what the labor side of things or the employment side of things could be stickier, or maybe is it possible when supply chain things ease and people run out of some of the pandemic savings, does that ease too in the labor market? Especially we're going to see Friday, maybe that's weakening too. And so I don't know whether it's transitory, but maybe it's quasi-transitory.
Well, I wouldn't use the word transitory, Joe. And I think, as you put out, that's been retired. That's been retired from everyone's dictionary. Look, I think the challenge is that this inflation has 2 or 3 different causes that are really quite distinct. One is the geopolitics, energy in particular, in some countries, food as well. We obviously have supply chain issues, which are some driven by geopolitics, some driven by, health issues in China, et cetera. And then we have here a very, very tight labor market, which was, a sign of an economy that was doing very, very well. And the reason people have trouble sort of talking about that with one word is it's not one thing. And so we'll observe them all changing over time. But you put your finger on the one I think is most likely to be with us for a longer period of time, which is that very tight labor market. Everyone wants relatively tight labor markets, but there comes a point where wage pressures start to pick up, and that becomes worrisome and problematic. And so that is, I think, the challenge. That's why to say it's transitory is not right. And the Fed is working hard, and will be, to get demand down closer to supply. They're going to try to avoid dipping us into a recession, obviously, but they've said they're ready to take that risk if need be.
Shepard Smith here. Thanks for watching CNBC on YouTube.